Some things that affect a company's stock price are out of its control. We still need to be aware of them, though. Being unable to control something and preparing for it are two different things. If you were to look at how stock prices behave during a recession, for example, you'd find a fairly consistent relationship. The S&P 500 declined during all 6 recessions between 1956 and 1987. If you move to more recent times, that pattern holds. The stock market fell during the 3 recessions of 1990 to 91, the early 21st century, and the so-called Great Recession of 2007. Every time that the economy has gone into a recession since 1950, stocks have declined significantly. That makes sense. The word recession connotes an economic downturn or contraction. The unofficial definition of a recession is 2 consecutive quarters of declining gross domestic product, more commonly called just GDP. GDP is the total value of the nation's production of goods and services. If a nation produces less, then people earn less and they buy less. Companies sell less and they earn less. Because stocks are claims on those company earnings, I'm not at all surprised that investors decide that they don't want to pay as much for those claims as they would during good times. Can we make money on this information? If we can predict recessions, then we ought to be able to sell beforehand and buy when the economy rebounds. Let's think about how we'd make that work. First, we'd need to be able to forecast turning points of the economy. Second, we'd need to sell before other investors see the recession coming. Third, we'd need to start buying again before other investors see the light at the end of the tunnel. We do have some reasonably good predictors of economic activity. The Conference Board Leading Economic Index, more commonly called just the Index of Leading Economic Indicators, is the best known. This index is a composite of about 10 factors, such as consumer expectations, initial unemployment claims, and new orders for consumer goods. The problem with using this to call market trends is that the information it uses is available to market participants who can make their own guesses and act at least as fast as we can. This means that any decline in stock prices as we head into a recession should begin before the recession. And in fact, that's what tends to happen. Stocks started declining before every recession since at least 1950. Investors see the economic contraction coming. Okay, you say, then why don't we just wait for stocks to signal a recession by declining and then sell before the onset of the recession itself? History shows that stocks have continued to decline after the recession starts, so we ought to be able to save some money. History also shows us 3 problems with this plan. First, since at least 1950, stocks have always declined during recessions, but every decline hasn't signaled an imminent recession. Cynical analysts like to say that the stock market has successfully predicted 16 of the last 9 recessions. This means that if we had followed our rule of selling after a decline, then we would have sold 7 times when we shouldn't have. For example, we'd have sold near the end of 2012 and missed a run-up of almost 40% over the next 10 or 12 months. Second, we don't have a good way to tell how long the stock market downturn will last. John P. Hussman, president of Hussman Investment Trust, has found that serious market declines, let's call them bear markets, that occur during recessions last longer than what he calls a standalone bear market. Hussman says that from 1950 to 2007, the 7 standalone bear markets lasted an average of 215 days. In contrast, the 9 bear markets that coincided with recessions lasted more than twice as long, an average of